All right, dear investors and traders and investment analysts. Today, let's try to calculate VaR or value at risk. This is very simple but very useful calculation for you. VaR or value at risk, this model, in simple terms, it shows your possible loss. It can be calculated for a single stock or a portfolio of assets or portfolio of stocks. It can apply to foreign currencies, to currency pairs, and also to equities. Since I talk about equities or stocks mainly, I will show you example of how you can calculate it with stocks. But if you are using some currency pairs, you can do the same calculation, just extract currency pairs, their prices, and you can perform this simple analysis. I will guide you through the step-by-step process. For this, we'll be using the financial modeling prep data points and Google Sheets. First, before using it, you have to install FMP or Financial Modeling Prep add-on. I will put the link down to this video of how to install it. I will put the link and instructions of how to register, obtain your custom API key, and then go to extensions and add this add-on on Financial Modeling Prep. After that, you will have this FMP down on this tab, and you will be able to use it. So once you install the FMP, open the Google Sheets, and here is a simple formula that you should use. Basically, write down the tickers. Let's say you have a portfolio of 5 stocks and you want to calculate the VaR or value at risk, your maximum possible portfolio loss, what you can encounter while you hold these stocks in your portfolio. So let's do this in that video. So first of all, let's extract the closing prices. In this example, I'm taking the stock closing prices from the beginning of the year up to current date, but ideally you should take maybe 3, 4 years, even 5. The larger your period, the more accurate your data will be. So first of all, let's use the FMP formula. You press open the Google Sheets. After installing add-on, you press here equal sign right in front of your ticker, and then you press FMP historical. As you can see, historical chart already opened, and now you have different parameters here which you should input. First is your symbol. We are interested in Apple shares. Then you go with the second parameter, it's the time frame. This is very important. We are putting 1 day, which means that we're extracting data for each day, starting from this date and ending to this date. So I'm inputting 1 day. Then the next thing we gonna use is the start date from and the end date to. Then the rest we're just skipping it and go to the headers. Since we're interested in extracting the closing price for the day, I'll just write the word close. And after that, you can close the parentheses, and it will extract the closing price for Apple shares for this date range that you've indicated, probably from here to in here. But as I have already said, you should take a larger data set and your data would be more accurate. So we extracted Apple closing prices for those dates, for this date range. Then we can do the same thing for Microsoft, Alibaba, Google, and Amazon shares. To do this, first let's make some edits here. First, these two cells, they will be fixed. Just go to this cell, stand on this cell, and press function F and F4 key on your Mac. You see these are $2 signs appeared. That means that your cells are fixed. We do this in order to make the cells fixed. They shouldn't be moving. So when we move this cell to in here, for example, to Microsoft, you see it's calculating for the Microsoft, it's extracting the data right now. This cell is moving, and these two cells with dates are not moving. That's why we fixed them with function F4 key. This is very important. And this cell is moving. Now let's extract the same thing for the remaining shares over here. This is the first step, download closing prices. We've downloaded the closing prices using Financial Modeling Prep endpoints. Now, the next thing you should do is you should calculate the percentage changes for your selected stocks. There are two options of how you can calculate the percentage changes. Is simply subtract the last date by the previous date and divide by the previous date. You get the percentage change. Or you can use the natural logarithm. Natural logarithm is good if you want to smooth the data. Let's say that your stocks are very volatile. One day it's 2%, another day it's 3%, another day it's 8%. It is closing in with gaps or closing with huge volatility. In this case, you need to use the natural logarithm, that is smoothing your data. So let me show you how you can calculate your percentage changes using the natural logarithm. Simply put ln logarithm, open parentheses, and then divide your last number by the previous number, and you get the percentage change. We will later turn it to the percentage terms, and now you expand everything to the last date, to the last closing price, and you get the percentage changes. Just ignore this one, and you get the percentage changes for each day for Apple shares. You can do same for other stocks in your portfolio like that, and you get the percentage changes. Just expand this rows to all the observations that we have, and now you get the percentage changes for your for the ease of use. You can convert those to the percentage numbers, and you get the percentage changes for each share in your portfolio. The next step is to calculate the variance covariance matrix for your portfolio of stocks. So what is variance covariance matrix? In the simple terms, variance covariance matrix represents the dependence of each asset. So how each asset depend on each other, whether they move in tandem or no, whether they move together or no. And it also shows you the deepness of this tandem, this dependence. We need this variance covariance matrix in order to proceed to the further steps. So this stage is very important. Now in Excel, if you're using the Microsoft Excel, this is very straightforward. You go to data, then data analysis, choose the covariance, and then you can build this matrix very simply. In Google Sheets, you have a paid option. In extensions, you can download the add-on, install the add-on, but it's paid, and I don't want to use that. That's why I will show you the manual approach of how you can do that. First, we need to calculate the variances, and then we calculate the covariances. Let's start with the Apple shares. You use the simple formula VaR P. The P stands for the population, and you basically take the Apple share, you take the percentage changes, percentage returns that we've calculated from the previous step, and calculate everything that you have in your observations. Then you do the same for Microsoft shares. You use the VaR P formula, and you do the same step as we did previously, and repeat the step for all the stocks in your portfolio. Let me finish with Alibaba shares. And now the next goes Google. And the last one is Amazon. Now we are calculating the covariance. For covariance, we need two data sets. Just input covar, this covariance, Microsoft and Apple. First data set is Microsoft shares. Then the second is Apple. You take the Apple. Yes, and we've calculated the covariance. Do the same for Alibaba and Apple. Do the same for Google and Apple. And Amazon. So you take Amazon and Apple shares. The manual approach is a little bit long, but at least you're not paying for the data. For Microsoft, we already know the Microsoft and Apple. That's why you can copy Microsoft and Apple from here. We already know Alibaba and Apple, so you can also copy it from here. We already know Google and Apple, so you can also copy it from here. And we know Amazon and Apple, so you also copy it from here. Now the next step, we do the Microsoft and Alibaba. So that's a Microsoft and then Alibaba shares. Then we do Google and Microsoft. Then we do Microsoft. And then we do Microsoft and Amazon. Microsoft and Amazon. Then you can copy, you already know the Alibaba and Microsoft. You can copy it from here. You also know Google and Microsoft from here. And you know Amazon and Microsoft. Copy it from here. Now you have Alibaba and Google. Alibaba and Amazon. And copy it from here. Alibaba and Google. Then you have Alibaba and Amazon. And now you need just Google and Amazon. Google and Amazon. Google and Amazon. And you copy it from here as well. You just simply put equal sign and put it here. So we build the variance covariance matrix. It shows the dependence of each asset. Oh, we missed Microsoft and Apple. Microsoft and Apple is over here. Now the step number 4 is to allocate weights. Let's say you're putting the equal weights. You can change it later, but for now let's put equal weights. So the sum of all the weights should equal to 1 or 100%. Suppose that you invest in each share 20%. Now we calculate the average return. The step number 5, it's straightforward formula. You take the average and you go to the returns that we've already calculated. You take the average returns from here and you just continue the cells. As you can see, the formula is already calculating everything. Then we calculate the average portfolio return. Our average portfolio return is simply the weighted average portfolio return. That is, I am multiplying the average by the Apple weight plus average return for Microsoft multiplied by Microsoft weight plus Alibaba average return multiplied by Alibaba weight and so forth. So this is the weighted average of all the returns. The next step, step number 7, is to calculate the portfolio's standard deviation. As you can see, first we calculate the variance. This step is to calculate the variance. And as you know, the standard deviation is simply the square root of variance. So that's why at the beginning I put the square root and then I multiply the stock weights by the variance covariance matrix that we just had. You can copy this simple formula from here. It's a square root multiplicators, then you use the transpose, you use the weights, then you use the variance covariance matrix, and again you use the weights. This formula is for calculating the variance, and then you take the square root and you get the portfolio standard deviation. In simple terms, portfolio standard deviation is simply the portfolio's volatility. So the next step would be to calculate the riskless volume, something that is risk-free, so to say, if we can use it. But of course, the term risk-free is used to the treasury yields, not the stocks. But in this sense, we can use something that is safe from the big loss, this amount. For that, you need the portfolio value. Let's say you're investing $100,000 in these 5 stocks. That would be your portfolio value. Of course, if you're investing the $10,000, you can input the 10K over here. This is your initial number, which is you investing. That's my portfolio value. And here is the simple, straightforward formula. We're using the normal inverse distribution for this. You can just copy the formula from here. 001, that means that we are using the 99% confidence level. So with the 99% confidence, we are calculating the portfolio's expected loss right now. But since we are calculating the riskless volume, this is the inverse relationship. That's why we're not taking 99%, but we are taking 0.01. So it's just 1% to demonstrate the riskless volume. Then you take the average portfolio return, 1 plus average portfolio return multiplied by portfolio value, and then you take the again you take the portfolio's value and calculate by multiply by the standard deviation. Again, you can see this simple formula of normal inverse distribution. This is the statistical term, and you get the 97,000. This is your riskless volume, so to say, from your portfolio. And then the next step is very easy. You just basically take 100,000, your portfolio value, minus this riskless volume, and you get 2,519.22 cents. That's your value at risk, your maximum possible loss that you can encounter while holding these stocks. So now you know how you can calculate your portfolio's ROAS using the VaR or value at risk model. Thank you very much for watching. I'll put the link to my Twitter. If you have some questions, you can reach me out, or also subscribe to my Twitter, because I post very important articles, tutorials, and share stock market apps that you can use to analyze your favorite shares. Thank you very much for watching this analysis.